Hey folks, welcome back to Honey Money SG, and this time let's talk about the S&P 500 versus NASDAQ. Which one should you invest in? Now, when we talk about index funds, right, I think a lot of you are really familiar with the S&P 500, which tracks the largest US companies, the top 500 by market cap, and they will include this in the index that you could invest via a tracker ETF, right? But what about the other one, NASDAQ? Do you even know what it is? To put it simply, NASDAQ is like the index that tracks a higher focus on tech companies in the US, and it plays a higher weightage on that. So I'll talk more in this video. But if this is the first time that you're watching, then I'll just give a brief introduction on what is the S&P 500. So the S&P 500 is basically a US market index that tracks the top 500 US companies by the market capitalization, which means the total number of public shares available in the market multiplied by the stock price that will be the market cap. So essentially it takes like the biggest companies in the US. And why do people like to invest in the S&P 500 is because it offers a lot of depth and diversity, right? It's really diversified because we are talking about 500 best companies by market cap, the biggest ones, right? We don't want those really small shrimps and small fries companies, and maybe they don't have really good financials. And in fact, the S&P actually has a self-cleansing criteria, right? That means those companies that don't make it to the mark, they will be replaced by the better companies that are eligible for the S&P 500 criteria. So just to quote from the original source, right, to be eligible for the S&P 500 index inclusion, a company should be a US company and have a market cap of at least 11.8 billion, be highly liquid and a public float of at least 10% of its shares outstanding, and the most recent quarter earnings and the sum of its trailing 4 consecutive quarters earnings must be positive. So that's like a really high bar to hit, right? You need to make sure that you have positive earnings. That means your company must be consecutively earning money for this quarter as well as the previous few quarters. So that is like a really good criteria because we don't really want all those poor performing companies in the S&P 500 index. And that is the reason why S&P 500 is so popular, right? Because you don't have to pick the companies yourself. The self-cleansing criteria will pick the best 500 companies for you. So you can spend your time doing other things that are more meaningful in life than go and research all the things behind the stock. Now, you can't directly invest in the S&P 500 index because that's not available for trading. But what you could do is you could invest in the tracker funds that tracks the S&P 500, and they are available in many kinds of ETF, right? Some of the more popular ones being like VOO or SPLG, those are listed in the US. And then we also have ticker CSPX, which is listed in the London Stock Exchange. So for those of you who have access to the London Stock Exchange trading via your interactive brokers, then I think that will be the best option for you to invest in CSPX. Otherwise, if you're using other brokers like Moomoo or Tiger Brokers, right, where you could get like one free Apple stock, then you can go and buy the VOO or SPLG. And the reason why some people prefer CSPX is because it's domiciled in Ireland, so there's like 15% withholding tax compared to 30% withholding tax in like VOO. Of course, there are other concerns like estate taxes as well, so maybe buying into the London Stock Exchange ticker CSPX will be more tax advantageous, especially when the S&P 500 typically will yield around 1.5% dividend yield per year. So you have to take like a 15% or 13% haircut because of the withholding taxes, and then those remaining will be paid out to you. Now let's talk about NASDAQ, right? When we are talking about NASDAQ, it's actually the market. And the NASDAQ that we talk about are more familiarly known as the NASDAQ 100, which is the 100 top companies that are listed within the NASDAQ index. And these are companies which has huge focus on tech. Companies like your Apple, Microsoft, Google, these are one of the top few names, right? Especially in the manga companies. And because these tech companies, usually they will use their earnings to go and invest in their business instead of paying out as dividends, because they felt that rather than paying out as dividends, they could use the cash to go and research and reinvest back to the business, maybe buy back more shares even. So there's really very little dividends to be paid out to the shareholders, which is why withholding tax will not be much of an impact if you're trying to invest in the NASDAQ. So some of the notable tickers include QQQ, QQQM, and CNDX in the LSE. But like I said, there's no point in investing in CNDX in the London Stock Exchange because there's really so little dividends to be paid out, right? So just invest in the more liquid funds like the QQQ or the QQQM if you prefer a lower expense ratio. All these funds can be invested in interactive brokers, Tiger or Moomoo, right? Just select the best one that you want to use. So what is the difference primarily between S&P 500 and NASDAQ. So for the past 10 years historical performance, right, we can actually see that the NASDAQ actually performed better than the S&P 500 because of their larger weightage towards the big tech firms like Apple, Microsoft and Google. These companies have really run up over the past few years because of their products and their innovation and the value that they provide to the shareholders as well as their customers. So because NASDAQ actually have a relatively higher weightage of these big tech companies, that is why the results may seem that NASDAQ is actually better than the S&P 500. But you must understand that because of the larger weightage of these tech firms as well, NASDAQ is ultimately more volatile. Because when we are talking about tech companies, they are more affected by macroeconomic factors such as interest rates, right? As interest rates rise, their ability to borrow becomes more expensive. They have to pay back more interest expense to the financial institutions when they are borrowing money. So that will hurt them greatly in an interest rate rising environment. But in good times when the earnings are consistently good for the next few quarters, right, then you will see NASDAQ actually outpacing the S&P 500 because all these big tech companies can really give so much more value than what the companies in S&P 500 are giving you. Of course, it also boils down to your exposure, right? Your risk exposure. How much risk do you want to be exposed to? Now, S&P 500 is actually a broad-based index, so it includes like every company from every industry, from any kind of business, any kind of sector, whereas the NASDAQ is actually very tech focused, so they really focus on the tech companies and excluding the financial companies, right? Especially when you are buying QQQ. It specifically said that it will exclude the financial companies, so those includes like your banks. And if we compare the components between S&P 500 and QQQ, the top few companies are really similar, right? Because we are talking about companies like Apple, Microsoft, Google, these companies, but the difference is the weightage. You see, if we're taking the top example, which is Apple, right, it's only like 6% in the S&P 500 weightage, whereas for Apple in the NASDAQ, it's actually like double of it, 12%. And that's why investing in NASDAQ ETFs like QQQ is much more volatile, and we can see the upswing and the downswing being more violent than the S&P 500. So that is something that you have to accept as a risk, and most importantly, understand your own risk appetite and your company's preference. Or you could do like a percentage allocation, right? Maybe you want to play it more safe, you can have like 70% S&P 500, 30% NASDAQ. Or if you're more adventurous, you could do like half split, 50-50. It's really up to you, right? All this thing is really based on your own risk appetite. I'm not here to really advise you on what to do. But what I can advise you to do is to sign up using my referral link to get your interactive brokers, your Momo brokers, or your Tiger brokers, right? Rather than having no promos to sign up, I think you can get some nice sign up gifts there. Now, one other method to trade is using the SiveTrade app because it gives you like 2 free trades per month after the promo period. So you can take a look at my SiveTrade video here on how you could use SiveTrade to cut costs on investing. With that, thank you for watching. My name is Christopher. This is Honey Money SG, steering young adults to financial independence.